Yeah, do you make this move on Fed fund futures heading negative? Is that really just a technical move, or do you think the Fed can actually really go down that route?
Well, thank you very much for having me. I think, as you indicated, that there's likely some technical factors at play here in the short term. If you listen to what the Fed has said recently and historically, they've been pretty clear that the effective lower bound is zero. So we'd be surprised if we get to a point where they actually cut rates below zero. But that said, we are in fairly unprecedented economic times, and there's a great deal of uncertainty out there. I think as we look at the world today, it's all about how the reopening goes globally. You start to see Europe opening, the U.S., even where I live here in North Carolina. Tomorrow they lift the stay-at-home order, and the phase one of the reopening of the local economy goes here, and we'll start to see this roll out now more broadly. And so it's really, the real focus is how that reopening goes and how that translates into the economy in the second half of the year.
Yeah, and we continue to see a pretty grim economic picture here with the latest jobless claims number, no let up in sight. We're expecting that non-farm payrolls coming out later on today. One of the worst prints we've seen since the post-war. So is the market still suggesting, even if it is technical, that perhaps the Fed needs to do more, David?
Well, it's all the lagging indicators are certainly bad. The situation we're in is bad and unprecedented in terms of how quickly this has come on and how broad-based this shutdown has been. I think the Fed has done a lot to improve liquidity in the market. They've injected a lot of liquidity. They stabilized the market. And at this point, it really is about how the reopening goes. And so that is what investors are focused on. That's what we're focused on. We're optimistic, but it's really going to be following sort of the real-time economic data. There's a lot of data you can follow real-time to see how things are going. Hopefully the virus stays under control. And then the Fed, will react accordingly as things evolve. Again, central banks around the world have indicated they're going to be, do the proverbial whatever it takes. But we're optimistic that as the economy starts to reopen, you'll see some green shoots, and it'll take some time. This again is unprecedented, but we're optimistic that we'll make progress and the economy will gradually improve.
We're looking at bond yields exceeding 10%. There's so much appetite for risk. I mean, what do you make of that?
Well, I think the market, as we look at the world, I think the markets, I think very high level that the markets really separated companies into three buckets. There were companies that were having trouble before the coronavirus came upon us. So you think highly levered retailers, and you've seen companies like Neiman Marcus and J.Crew recently file for bankruptcy, and perhaps the current events have really just accelerated those. You've got another group of companies that are otherwise good companies that have just been, completely shut down by this. So companies that were doing well but have now had to shut down completely, and they just need liquidity. And so you've seen the market, receptive to those kinds of companies coming to the market and raising liquidity. And there's some optimism that those companies will, when we get to the other side of this, be very good companies again. And there's another set of companies that, of course, are doing very well in this environment. You think of a company like Netflix or television broadcasters that have higher viewerships. And so, there's a broad spectrum. So when you look at market yields, you have to kind of go another layer down and look at the different types of companies there. And it's really about, these are times where active managers, which is what we are at Barings, can really make a difference in trying to go through all those different types of companies and find the best risk-adjusted opportunities for our clients.
Just a question to do with those junk bonds. I mean, we're seeing those rating downgrades to junk. Have we seen the worst, David?
Well, I think that all depends on how the economy unfolds. Clearly, the agencies have been, quick to downgrade companies that are having issues. It depends on the shape of the recovery. I think, the prospects of a V recovery are looking less and less likely, but a U-shaped recovery, again, if the economy opening goes well over the next several months and you start to see more and more economic activity, businesses get back to work and start generating cash, and liquidity companies are raising, gets them to the other side of this, then certainly we think there could be a moderation in the pace of downgrades. So it's all about that forward look, and that's what we're focused on.